To receive the templates of the charts featured in this video, please visit us at backtothefuturetrading.com/unplugged. I was looking through the NinjaTrader indicators that come free with the package, and one of the very first ones up top is the APZ, or the Adaptive Price Zone. And I wanted to show you how you can use that today as a rules-based trading system indicator. The Adaptive Price Zone is a technical indicator developed by Lee Leibfarth and was first described in the Technical Analysis of Stocks and Commodities, September of 2006. Especially useful in non-trending choppy markets, the APZ was created to help traders find potential turning points in the markets. And we're going to show how you can use that today as part of a rules-based trading system, and I'm going to use CL as a base instrument to demonstrate that principle. What we're looking for here are essentially violations of these bands, and I'm going to start our theoretical rules-based trading system at 8 o'clock Eastern Time in the morning, an hour before the pit opens for crude. What we're looking for, obviously here, are penetrations of these bands. As you can see these bands, we need to talk a little bit about the calculations that form them. The APZ calculations form two bands that appear over a price chart. The upper and lower bands are neither uniform nor symmetrical. In contrast, the bands that are formed by the APZ take into consideration volatility and change in shape and width, the distance from each other, as changes in price activity occur. In general, the distance between the upper and lower APZ bands will increase with larger price swings and will decrease or constrict during periods of decreased price movement. Therefore, wide bands are indicative of increased volatility, and narrow bands, when the space is decreased between the bands, represents periods of decreased volatility. They act in many ways like a Bollinger Band, very commonly used in many trade rooms of this industry. So here what we're going to look for is essentially a penetration of the upper or lower band. And you can see starting at 8 o'clock, we have that penetration by a bullish candle. Now I want to look at several rules here. We'll put them on the screen one at a time. Number one, a penetration. When we have a penetration of the band, it's a signal that we're going to be looking for a reversal signal to go long or short. And in this case, we have a bullish penetration of the upper band. The confirmation of the entry is a reversal, opposite reversal bar. So let's put that on here too. Second signal, opposite reversal. Now we have a question of money management. How are we going to manage the trade? Okay, first thing we're going to do is have a stop. Stop is one tick above or below the reversal candle. So in this case, had we gone short right here, the reversal candle is clearly the one at 8:02 and 15 seconds. So our stop would go one tick above 93.24 or 93.25. Our target in the market is going to be three times the average true range, which is easy to calculate with an 8 range bar. That would be 8 times 3 or 24. So every time we see a signal, we're looking for 3 times the value that we're risking plus 1. So we're essentially going for a 9 tick stop with a 24 tick target. That's a good healthy RR. And you can see here as we go through the chart using just the APX, starting our system at 8 o'clock and ending it at the close. And you can build in lunchtime requirements to this as well. You can see over the course of a day that we have several signals. The first one is a winner for 24 ticks. The second one is a break-even rule, and I've just applied that here. If you're the kind of trader like me or my partner especially, you like to go break-even if the market hits the halfway point, or if we get to 12 ticks. My partner hates giving all that profit back, or at least going into a losing position. So go to break even at a halfway point, gives you a 12 tick buffer to say, I'm going to lock in some profit here. So in this case, we have the market enter and we reverse and go down 3 times the ATR for a profit target of 24. We have a break-even trade here where the market reverses and we have essentially a break-even trade. Then we have a touch of the lower band with our reversal candle here at 93.31 for a profit target of 24. Similarly, we come up and we start violating the band. We penetrate it. We have a reversal candle here with an entry at 93.96, and we get our 3 times ATR target. Similarly, we come up and we touch the upper band. We break through it. Our reversal candle closes at 94, and we get our 24 tick target. So as you can see, this is a very useful system in identifying potential entries and exits that comes standard in the NinjaTrader indicator list. And if we just apply a rules-based system using very simple entry and exit rules and some common sense money management techniques, you can see that we can be wrong 3 times as often as we are right and still finish the day flat. And if we're right a little more often than we're wrong, the profitability of the system becomes apparent. One of the other things I want to indicate before we close real quick is the addition of ADX. Remember, we use that indicator in other templates. And some technical analysts look at the ADX to verify that the market is below 30. When the market is below 30, we are not trending and we're sort of in a choppy bang around market. So if you want to use that, you can potentially filter out some big losers or a lot of losers by identifying a market condition where we're not really trending hard. So again, this could be a 6th condition that says when the ADX is less than 30, a trade is possible. I'll save this template up on our website. If you have any questions about it or any of the other videos that we've posted in our series, let me know. I'm Michael at backtothefuturetrading.com. Appreciate your time. And remember, NinjaTrader comes with a lot of great stuff unplugged.